But yeah, to kind of echo what Billy was saying, if you guys have questions kind of throughout the materials, feel free to ask either in the chat that Billy's going to be monitoring, or if you want to come up and ask live question, feel free. I definitely want people to be able to ask questions kind of throughout if there's anything that's not clear or you want me to expand a little bit. And then at the end, of course, we'll have a more lengthy Q&A as well, if there's just kind of broad questions. But definitely if there's specific things kind of while I'm going through stuff, definitely don't hesitate to ask. So yeah, I guess with that, Billy, you cool if we get started?
Yes, I will mute myself. Okay, guys.
Cool. Um, so yeah, I guess before I kind of share the materials I've prepared, I'll give a kind of quick introduction. My Web3 name is Ox Fibonacci, or Fibonacci, or Fib. The only thing I don't like being called is Fibbo. It sounds like a dog, but any of the others are fine. And I guess, yeah, I bought my first Bitcoin when BTC Futures launched in October 2017. So I have kind of been in the crypto Web3 space for a number of years, seen a few cycles. Really, I guess I was an actuarial consultant for about 6 years, which is essentially means I was really good at math and Excel and probabilities, which obviously owes itself to trading nicely. So, kind of went down the rabbit hole with NFTs in 2021, starting with VFriends and kind of a whole bunch of other things. And that was kind of my main side hustle, I guess, for a couple years, and then was consistent enough with that to quit my corporate job and went full time kind of trader, whether it's crypto, NFTs, whatever. A little over 2 years ago, March of 2022, and then after the NFT volume started dying down, I pivoted to more just trading crypto, just the price action, because I knew there was always going to be something, even if NFT volume wasn't great or if price was going down. And then probably about, I would say, August of last year, I kind of pivoted to full time traditional finance trading. So more stock indices, US 30, the Dow, S&P, NASDAQ, a little bit of gold as well. And so I'll kind of talk through my thought process of kind of making those transitions, kind of the differences I've learned from trading the different things, as well as a really cool, I guess, opportunity called prop firms that I've taken advantage of more recently. And yeah, I wanted to kind of take the time to share with you guys what I've learned, specifically to transition from kind of a boom and bust trader to more of a consistent, profitable trader, to the point I was able to get 7 figures funded with some of these prop firms and get some payouts. And it's something that I do think is duplicatable if you follow the same process, if you put in the same work. I think this is a process that anyone can do, and it can work if you trade crypto or TradFi or whatever. So definitely hoping to provide you guys with some really good value. And with that, I guess I'll share my screen. So let me get this PDF pulled up. And Billy, once I get it streamed, feel free to let me know if it's showing up okay. Can you guys see this PDF?
Yes, perfect.
Okay, cool. So yeah, what are we gonna go over today? So I'm gonna start with kind of defining what is an edge in terms of kind of the trading space, how to develop one, the importance of backtesting and forward testing, the psychology and habits that are necessary to consistently trade an edge. And I'm going to be bringing a lot of information from Mark Douglas's Trading in the Zone, which is a phenomenal, phenomenal book. I highly, highly recommend it. So I've got some resources at the end of this material with kind of links to that book, as well as he did like a YouTube seminar that you can watch as well. Gonna go through the mechanical trading process with kind of a real example of this kind of 15-minute pattern strategy that I developed as an edge. Kind of walk you through the variables for it, some examples, and also the risk management considerations while executing an edge. And then finally, as I mentioned, we're gonna kind of discuss the world of prop firms. I know it's new to a lot of you, so kind of high level what they are, kind of the pros and cons of taking that route instead of trading a light account, as well as kind of three different options out there: CFDs, futures, and crypto. And then, of course, the kind of differences between crypto and TradFi. So yeah, with that, let's dive in. So, kind of the first thing: what is an edge, and how do you develop one as a trader? So to quote Mark Douglas from his book, an edge is nothing more than an indication of a higher probability of one thing happening. So all it means is you figured out some way that, based on the different variables, you have a higher probability of one outcome versus another. So really common example that he brings up in his book a lot is a casino. So a casino obviously is a very profitable business that kind of relies on a edge, where over a long period of time, they have a slightly higher edge odds of making money compared to all of the players, whether it's blackjack or anything else. And individually in each individual game or whatnot, there's completely random outcomes. Could be a loss, could be a win, but over the long term, over a series of, I guess, games in their case, they are going to be profitable due to that edge. So I wanted to kind of contrast what does it look like to trade a probabilistic edge versus kind of what most traders experience. So I know we probably have a fairly diverse group in here that, maybe shitcoins, maybe trades crypto, a few TradFi people. But I would say most traders definitely experience wins, hopefully. You've put on a winning trade or two, and you've been able to do that, but you've also probably experienced losses. My guess is substantial losses, because most people, without trading a mechanical edge, you trade emotionally more often than not, and a lot of like fear-based kind of mistakes lead to what's kind of the boom and bust cycle, where maybe you'll grow an account for a little bit and then kind of erase all the gains and more potentially. So there is a much better way to trade, where you're really just you're trying to be a robot, essentially, just trading the probabilities over a period of time and just trying to execute when these trade setups come up. And it can get to a point where trading is actually less stressful than driving, even if you build up the kind of muscles, I guess, to just execute and not really worry about the outcomes. So that's kind of what I want to share with you guys. So how to define an edge as a trader specifically? It's really just a fixed set of variables that define what instruments am I trading, what time frames, is this during a certain session, like London session, New York session, or certain hours of the day. What specifically defines when I should enter, and then when should I exit, either in a take profit or a stop loss. So really specific parameters that kind of tell you exactly when I should exit, when I should enter, when I should exit. There's no subjectivity whatsoever. It's just like a mechanical kind of rule set. And then kind of how do you develop this? The number one way is backtesting. And for those of you that aren't familiar, backtesting is essentially what I kind of compare to practice as a sports athlete for a trader. And it's essentially looking at past price data, price history, and anything that involves either time and price that you can kind of take advantage of that historical data. You can analyze, different variables and see kind of how would this set of variables played out in the past, and you can test, with pretty good accuracy, like what is the win rate of this strategy, what's the average risk to reward, what's the kind of biggest drawdown, things like that. And it'll kind of, I guess it serves two main purposes. The first one is obviously helping you identify if you are in fact actually trading an edge, or if you're just trading a non-profitable strategy. And then second of all, once you've figured out kind of a good strategy, it helps you build repetitions to help better identify those opportunities and kind of get you ready to trade it more in a live environment. And there's a really good application called FX Replay that I highly recommend. Again, at the end of this presentation, I've got a link with a discount code. I think you can get it about $30 a month. It's a really phenomenal tool that allows you to pretty seamlessly backtest old data. I did just want to mention for kind of crypto, I think they currently have about 6 pairs that you can test, kind of some of the larger caps. And so I guess I want to briefly mention too. So CFDs, it stands for contract for difference, and in the traditional finance space, it's basically just a less regulated leveraged instrument compared to futures. And the couple considerations I wanted to mention there is obviously for crypto, if you're a shitcoiner or you trade, altcoins that aren't in this suite, like the other options you have are just kind of going back through the price data manually on your exchange and kind of charting out the trades you would have taken and kind of tracking in Excel or something like that. Or I think TradingView, you can kind of use the replay function, but again, you'd have to kind of manually write the trades down, whereas FX Replay kind of captures them all for you in a nice way. And then kind of the other consideration is with both crypto and CFDs, there's definitely some price deviations between brokers. So obviously for crypto, Binance versus Bybit or MXC, there's slightly different price variances, and obviously for futures and spot, like there's also some variances. So that's just another thing you might want to take into consideration is at the end of the day, of course, whatever you're trading is probably the most important data to use. So if you use FX Replay for crypto and stuff, I would definitely kind of see how it compares to a small sample size on the actual exchange you use. Otherwise, like I said, I predominantly trade traditional finance futures, and one of the best things about that is there's only one exchange that can trade those futures, so there's no variability across exchanges or brokers. It's all kind of constant price, which is really nice. But just a couple of considerations for those other ones. And then forward testing. And I can, if we have time later, or if we want to do another live later, I'm happy to kind of demo FX Replay, but they've all got a lot of good resources and stuff as well. But then, so obviously once you figured out kind of a rule set from backtesting, there's a concept called forward testing, which is essentially testing the same variables in a live environment. So the main thing is you want to see some consistency in the kind of outcomes you were seeing in the backtest with the forward test. And you could actually be trading kind of when you're forward testing, or you can kind of take some time to build up that forward test before you feel comfortable trading it. And then over time, you might kind of notice a few things in the strategy that you might want to kind of revisit and try to optimize a few things. So, that's kind of another process that you can take advantage of as well. So Billy, reach out if there's any questions, but if not, I'll continue. Okay. So this is kind of a sample output from FX Replay of the US 30 backtest that I've shared for my 15-minute strategy, and kind of a few high-level observations I just want to share. Like kind of ideally, you really want to see like a gradually increasing equity curve for an edge. You don't want to see like a super volatile up and down, where there's huge upswings, huge downswings. You really want to see like a consistently rising equity curve is kind of the goal, I guess. And I would say anything that has over a 50% win rate and average of 2R plus, which means if your trade is right, you'll make 2 times as much as if it's wrong. That honestly should be sufficient to help define an edge. And then I would suggest like at least a 50 trade sample size to have a reasonable trade kind of data set to go after. And then of course, if you can test various market conditions, that's helpful. So this US 30 backtest is actually a 4-year backtest from 2020 through 2023. So it took me a long time to do, but it gave me confidence that through all kinds of different market conditions, the black swan COVID, through kind of choppy up and down markets, through kind of a little bit more of an up market, this strategy has consistently performed. So that's really what you want to see in a good backtest. And then you also obviously have the option for a little bit of a deeper dive with Excel. So FX Replay, you can kind of export the data and then do a little deeper dive. I happen to be really good at Excel, so I kind of did this, and I did what I mentioned. FX Replay is actually going to be adding some of this stuff innate within their analytics soon, so you won't have to do this in the near future, but you can kind of take the data, I think they recently added longs versus shorts already, but you can check, are the longs versus shorts different? Is there any certain days that, are underperforming or worth kind of skipping? This, for me in particular, so this is Denver time. I trade kind of the New York session, which is basically 9:30 Eastern till about 4 Eastern, I believe. So these are Denver times. I'm 2 hours before Eastern time. And what I had noticed is that it really wasn't worth my time to kind of trade the last, I guess, 3 hours of the session. There weren't as many trades, and I could capture about 90% of all the kind of profits by just trading these first 3.5 hours. So this kind of helped me, I guess, determine when I was going to be trading this strategy, which ended up basically being 9:30 Eastern to 1 Eastern. And then I had kind of mentioned the optimization piece. When we go over my pattern strategy, I basically have kind of a stop loss that I had defined, and I was kind of noticing for the US 30 and gold that it looked like I could use a tighter stop loss and maybe get some additional profits. And so I did a comparison, kind of using the more aggressive stop loss versus the kind of more conservative one, and I was able to increase the profits 27%. The win rate went down from 81% to 63%, so I think about a 22% decrease. So in my mind, it was more worth kind of doing this more aggressive because the profits increased more than the win rate decreased. But this kind of helps you analyze all this stuff to, understand more. Are there any days I should avoid? Are there any, time periods where I need to focus on because it does better during those times, or do I want to not trade certain hours? So this backtesting stuff just really gives you a lot of good information, so you can kind of have a more data-driven approach than you would otherwise. So again, Billy, feel free to reach out. But if I don't hear anything, I'm gonna keep going.
We have two questions.
Sure.
Gusu, I'm not sure how to pronounce it, but he asks, is the dashboard with the equity curve from FX Replay?
Is this dashboard that I shared from FX Replay? Was that the question?
Yeah.
Yes, this is an output from FX Replay.
And Shady asks, do you trade crypto during New York session?
So I really don't trade crypto hardly at all anymore. I've really kind of shifted to just traditional finance, and at the end of this, I'll kind of discuss that. But no, I typically only trade traditional finance at this point. So, but yeah, I'll go over some kind of comparisons at the end of this. So next thing I wanted to touch on is kind of the psychology and habits necessary to consistently trade an edge. And I apologize, this section is a little text heavy, but I wanted to get as much content as possible, and I'll try and elaborate on some of it. But I would say, the biggest thing in order to trade an edge consistently is kind of overcoming the fear and embracing consistency over anything else. And so I'm sure a lot of you are familiar with these kind of emotional mistakes that a lot of traders make, such as closing a trade too early. Maybe you put your stop loss to break even, it comes and hits it and then goes in your favor. Maybe you didn't hold a trade long enough until the proper take profit, or maybe you hesitated to take a trade, or obviously over leveraging is maybe one of the biggest mistakes. And these are all like fear-based kind of mistakes that traders make. And so a couple ways to overcome that fear. The biggest one is really like fully accepting the risk of the trades you take. Some of you may have, in the past taken what I would call immaterial trades, where, maybe it's a, $20 trade or $50 trade or something small enough that like it doesn't really matter, like if it's a win or a loss. And you might have kind of reflected back on those trades where like it really wasn't that stressful. You were pretty comfortable if it was a loss. And so if you can fully accept the risk of the trades you take, it really eliminates that fear. And combining, accepting the risk of the trade, if you can kind of keep rigid to your kind of rule set so that you can trust yourself 100% to manage the risk, then obviously, if you have a win streak, you got to be aware of overconfidence as well. But I would say accepting the risk, keeping rigid to your rules to manage the risk, and make sure to kind of check yourself if you're experiencing overconfidence. Those are the things that you need to do to execute consistently. And then Mark Douglas, in this kind of psychology seminar that I've also linked at the end of this, he talked about treating mechanical trading losses as like a business expense. And he was like, if you had a mom and pop shop and you had to buy some supplies or something, would you feel like emotional like writing that check? And he's like, no, it's just like kind of a part of the business. So to paraphrase, he said something like, trading losses are business expenses so that you can make yourself available for the trades that are right. So it's really just a shift in the way you think about and experience trading losses as kind of just an expense, a part of the business. And as long as you know that you are trading an edge, then you can be more comfortable kind of taking those losses without, feeling like you're bad or you're wrong or anything like that. And really this last bullet, I say this to myself all the time, there's a random distribution of wins and losses with any edge. Over a period of time, maybe it produces certain results, but individually, trade to trade, there could be any number of wins and losses outcomes. So your goal as a trader is really just to make yourself available to identify and execute the trades that have odds of moving in your favor and over a large enough sample size. And Mark Douglas recommends like a 20 to 25 trade sample size because it's it's big enough to let you know if it is working over a period of trades, and then it's short enough that if you are trading with live money, hopefully it's not gonna bankrupt you. It's gonna be a small enough amount of money that if it's not working in that live environment, you can make some adjustments and instead of continuing to trade it. So any questions there, Billy?
Yeah, just one coming in. When you talk about mechanical trades, do you automate any execution?
So I think long term, that is something that I personally will probably try to pursue with some of them. I mean, a lot of these are going to be pretty challenging to code, but Mark Douglas, in kind of learning to mechanically trade, he really recommends like actually physically taking the trades yourself so that you can kind of work through that fear and build up the repetitions and kind of fortitude you need to work through the stuff and build the right habits and things like that. So at least early on, he definitely recommends just doing it yourself and trying to execute as well as you can live. So there's a bunch of principles from trading in the zone that are too good. I have these on sticky notes on my wall. Like these are so good. So he has these 7 principles of consistency, and he talks about being a consistent winner. So we'll come back to that a little later, but I'm going to read these. So I am a consistent winner because I objectively identify my edges. I predefine the risk of every trade. I never take a trade without knowing, like, if I'm wrong, I'm only going to risk, X dollars. I completely accept the risk, or I'm willing to let go of the trade. So basically not extending your stop loss. If it hits it, you're out. You accept it and you're out. I act on my edges without reservation or hesitation. Even if you experienced a couple losses from the strategy, you still take the next one because over the long time it's going to give you the results you want. I really like this one. I pay myself as the market makes money available to me. So kind of going back on, there can be wins and losses over a period of time. So it's really just, when the strategy gives you those wins, that's when you kind of take your profits and pay yourself. But when it's, on a losing streak, that's just the business expenses. I continually monitor my susceptibility for making errors, and I've got some tips on how to do that in the next slide. And then I understand the absolute necessity of these principles of consistent success, and therefore I never violate them. So this is something I try to review like every week to really reinforce it. And then he has these 5 fundamental truths of trading as well. So, and I'll expand on these a little bit. So anything can happen. And these first two are kind of related. So you don't need to know what's going to happen next in order to make money. So when you think about when you place a trade, whether you're long or short, after you place that trade, you are entirely at the mercy of what everyone else is thinking and doing at that point. So since we don't have perfect information about why this other trader's buying, why this other trader's shorting, why this institution's buying, why this institution's selling, like we don't have that information, there's I guess a sense of randomness in kind of the outcomes after we get into the market. And with an edge, you can kind of determine statistically, from these guesses that I'm taking, more often than not, they should work in my favor. But within any individual trade, there's so much randomness in terms of, why these other people are buying or selling. Like, there's no way to guarantee the outcome of individual trades. And that's why, people who have no experience can get lucky and, buy and other people buy, or sell and other people sell and make money. And so that's why you don't have to know what's happening in order to make money. And once you realize that, hopefully it will help you get away from thinking, I know it's going to go this way, because once you kind of get in your head that it's going to go this way, oftentimes you'll get so fixated on that outcome, and it might make it more difficult to stick to your rules and exit when it's not doing what you expected. Kind of repeating this one, random distribution of wins and losses. Again, an edge is nothing more than an indication of a higher probability of one thing happening than another. And every moment in the market is unique. So even if something happened last time, there's no guarantees that same exact trade setup is going to yield the same results the next time. So these are really, really great kind of takeaways and principles from the book that I highly recommend. Again, printing out, putting on your wall or something to make sure you're kind of thinking about the market in a correct frame of mind and not getting so focused on any specific like biases or anything like that. So any questions, Billy?
Yeah, Akai Sato is asking regarding point 4. At what point would you consider market conditions changed and your edge is no longer valid?
So Mark Douglas typically says like, and edges do like change over time, right? I think if you're noticing over a large enough sample size that there's a deviation in kind of the live forward testing results versus your back test, that might be an indication that you need to kind of revisit maybe back test some additional market conditions in the past. Maybe if your initial back test was kind of in a bull market, maybe you might want to test the same variables in a bear market or a choppy market and kind of see, if it's yielding the same stuff. But yeah, if you need a sufficient sample size, right? Like, because any edge does have periods of losses and drawdown. That's very common. But if you have, he recommends a sample size of 20 to 25 trades. If you're seeing in kind of a sample size of that, nature, that there's significant deviations between the back test versus the forward test, that might, kind of tell you that you need to either test more market conditions or make some adjustments to the strategy. At least maybe stop trading it live in case, it continues to lose money.
He says, so, okay, basically back test in different conditions to confirm whether there's a deviation.
Yeah, backtesting multiple market conditions is the best like first step, because if you, like I said, if you only test maybe a bull market and you are in a live environment when the market's going down, you might naturally experience different results. So it's, I think, important when you do the back testing to try and test the variables in different market conditions, which again could be an upwards trending market, a downwards trending market, or a ranging market. Those are really the three kind of outcomes that we experience. Obviously black swans are maybe kind of unique, but the uptrend, downtrend, and ranging are really the main three market conditions, I would say. So if you can test in kind of each of those and it's pretty consistent, then that should give you reasonable confidence that the forward testing should also be consistent. But if it's not, then yeah, you might need to kind of review and tweak some things. Okay. So I have some practical trading tips from kind of the information I just shared with you. How do you execute this? So really, rather than any specific profit targets, I want to make 10% a month. I want to make $1,000 a day or $100 a day. You really need to just focus on the consistency, because if you trust that your edge will yield profits over a period of time, then your job as a trader is just to consistently trade it, regardless of the outcomes, day to day, week to week, because over a period of time it will give you those results. So shifting your focus to these consistency metrics that you can say I did a good job or bad job based on these metrics instead of the dollar signs, I think it helps you. And so the three things that I personally kind of grade myself on week to week are: what percent of all the potential mechanical trades that presented themselves was I able to execute this week? So maybe there were 4 trades this week, I was only able to hit 3 of them. That would be a 75% hit rate. What percent of all of your trades were mechanical versus discretionary? So trades that followed the edge variables versus trades that I just kind of felt like I wanted to take based on other information. And this one is the one you really have the most control of. Not taking a trade you shouldn't is kind of, I guess, it feels like the easiest thing, but it can definitely be hard at times, especially if you're feeling emotional, trying to kind of make up for a loss. Revenge trading, a lot of us have a that's I guess part of the process of building those muscles to catch yourself when you're kind of making that. But yeah, so the goal is obviously to predominantly or only trade your mechanical strategy versus taking all these other discretionary trades. And then how many mistakes did you make? And these are 3 things that I think if you can kind of track over a period of time and just aim for progress, like try to get better at them over a period of time, that's really like your number one goal. And then I would say improving your sense of awareness as a trader is really important in order to kind of catch yourself thinking the wrong thoughts, or trying maybe I should do this discretionary trade, or maybe I kind of want to close this one early. And if you improve your sense of self-awareness, you'll be able to catch yourself doing those and kind of prevent yourself from making those mistakes. And so meditation is phenomenal for that. Journaling, either kind of your trades, like the emotions you're processing during the trade, or in general just kind of journaling your own thoughts. And therapy, I'm a big proponent of it. I have weekly therapy where I work through a lot of different things and talk about kind of ups and downs and things like that. So I think it's really important as a trader to really spend time developing your mind and awareness through that stuff. And then I would say it's also equally important to add supporting evidence to the identity that you are a consistent winner. And in Trading in the Zone, he really talks about embodying kind of the identity of a consistent winner. And that might mean slightly different things to most of you, but, for most of us, things you can do to support that identity are, consistent workouts, consistent sleep routine or sleep hygiene, healthy diets, taking care of your body through recovery, maybe spending time with friends and family, doing things, taking care of your dog. Like, there's all kinds of things that, you can think about, what does a consistent winner look like for me? And try to do things that add evidence to that so that it will flow through to your trading as well. And then obviously, lastly, you want to definitely avoid distractions. I'm kind of, I guess, pretty hyper focused on eliminating notification distractions. Like, I've muted all social medias. I've muted almost all my Discords, like only the handful of ones that I care about. I like when I'm, I guess after, for me, 5 p.m., I have like this focus mode on my phone that disables all of my kind of like work-oriented applications. So I really think while you're trading and outside of it, like it's important to kind of protect your attention so that you can execute as well as possible. So kind of if there's things that are distracting you, try to change your environment or change what those things are, through notification adjustments to make sure you can focus better. So any questions on kind of these practical tips? No? Cool. So yeah, I'm gonna go through kind of a example, I guess, of this 15-minute pattern strategy, and I guess before I go into this too much, I don't know if there's an easy way to do this, but I wanted to kind of get a pulse because I know a lot of you guys are in Holland. How many of you guys are actually trading traditional finance during the New York session? I know my room is cold. We've spoken a little bit. Is there anyone else? So crypto for most. That was my guess. So I think for the group we have today, I am going to show you guys this strategy, but I'm not going to spend that much time specifically going through it. My room is cold. I'm happy to have a separate chat with you if you want, but my goal is to really show you guys like what does an edge look like in terms of the specific rules and a few examples of kind of the back testing, forward testing, more to show you guys kind of what it looks like and give you guys an example of, if I were to implement something like this for what I trade, this is kind of what I need to look for, if that's okay with everyone. So I happen to be really good at pattern recognition, and I had noticed just kind of from watching charts that wedges like worked, pretty reasonably consistently with certain market instruments. And so that was kind of the thing, what I started with. I was like, okay, I'm going to try and test these, rising and falling wedges, the breakouts and retests, things like that. And over a period of time, I was basically able to identify 3 different kind of ways to trade them and capture the price action when they happen. So this one, and I might be able to zoom in a little bit. Let me see if I can. If you guys can see that a little bit better. So this example on the left is kind of a standard pattern breakout and retest. So we had a rising wedge here, it broke down, retested, and continued. And in this example, for my strategy, I avoid news like the plague. So anything where there's news at the end of the session or the next day, I'll kind of close things early. But this is kind of your standard breakdown and retest. And then I also identified that, especially early in the session, so kind of, I guess, the first 3 candles of the New York session, if there was like a active breakout of a rising or falling wedge, I would kind of just like market enter as long as I could get the good risk to reward. So this was like a secondary entry that I was able to define. And then the third one was what I would call a recent retest. Where maybe during like the London session, a little bit before New York, it broke down and retested. So as long as I could get the 2-to-1 risk to reward, I might just market enter when New York opens, and kind of, assuming that it's already tested once, so maybe it won't again. And so those are kind of the 3 main entry parameters. And again, I won't spend too much time into all the specifics, but these are just things that I was able to kind of identify through pattern recognition and back testing over time. So within those 3 things, I think I skipped this one. Sorry. So again, the key variables for this strategy, again, I tested it. It works on the US 30, the S&P, or gold, and futures price action is similar enough that it works on these 3 futures instruments as well. It doesn't work on the NASDAQ, interestingly enough. I guess maybe it's a little more volatile. So again, I haven't tested this on crypto, but there's probably more correlation with the NASDAQ to crypto than some of these other ones. So this strategy might not work on BTC or other cryptos. You'd have to backtest it. But a breakout is basically, I defined it as kind of for a falling wedge, at least 2 consecutive, or sorry, for a rising, it's red or green, I guess, depending which way it is, but it's 2 consecutive candles kind of in the direction of the breakouts. So if I guess zoom in here a little bit, I might need to zoom in a little more. So in this kind of screenshot here, you can see when price broke out here, there was, several examples where there's at least 2 green candles in a row. So really after this first, and they just have to close like above the breakout trend line. So that was one example, and I couldn't find a good screenshot of it, but I was also able to kind of define a secondary confirmation where there's like a super strong candle that closes, that basically closes, say it's a say it's a falling wedge. You see a big, engulfing green candle that closes near the high of the candle. As long as the next candle closes also like above the wedge, then even if it's red, then I would say that's a confirmed breakout as well. So at least this is what I defined for this strategy. You might have slightly different definitions, but this is kind of what I use to define a confirmed breakout. And then a measured move is basically these orange lines. So when I was drawing the wedges, you kind of connect the second trend line to the first, and that gives you kind of what's called a measured move. And I would add it to where price retested. And I really only use this to just make sure, like when I'm looking for a profit target, in my case that was at least like 2 risk to reward. I needed to make sure it wasn't like crazy, super a lot higher than this measured move. Like it needed to be within this for the most part. Again, not going to spend a whole lot of time going through the specifics, but I had some other rules with this strategy. Again, not trading news. If the breakout, kind of took all the liquidity before a retest, this one didn't end up retesting, it was close. But if it kind of took all the liquidity on the breakout, then I would kind of assume the move was probably already over, and I wouldn't actually take the trade when it retested. And then a lot of times, I don't know if you guys can see this, but there will be like kind of fake outs where there will be like a wick below, and it'll kind of go back into the wedge. And when this would happen, I would just adjust my trend line to that kind of most recent wick, so things like that. And then I guess, risk management considerations for any edge. You have to determine like an appropriate dollar risk per trade when mechanically executing for the first time. You could have the best strategy in the world, but if you risk too much, you're gonna run out of money before it works. So some of there might be certain prop firm drawdown limits, or maybe you're trading a personal account and you're not willing to lose more than X dollars. Figuring out if this strategy works in a live environment. There's this really good risk of ruin resource that I can pull up real briefly if my computer allows me. So it basically allows you to put in what's the win rate of your strategy, what's the average risk to reward of your strategy, US aren't supposed to use this. What's the risk per trade you use, and kind of what's the period of trades you want to check over time, and it'll give you statistics on kind of the probability of reaching the drawdown that you've mentioned, or this risk of ruin. So it gives you good information that you might make some tweaks to these to get these numbers low enough for you to be comfortable. Maybe you're comfortable if there's a 5 or 10% chance of it going down, or maybe you want to completely eliminate that risk, and so you give yourself a little bit bigger of a buffer. But the whole goal is to figure out kind of what can I accept as a risk per trade for these 20 to 25 mechanical trades, and if you accept that, you'll be able to more comfortably trade without that fear, since you're comfortable with the risk. And then obviously while executing, you need to use some kind of tool or method to define the risk of each trade. So I trade futures, and I take advantage of the kind of long and short tool and kind of calculate my risk each trade. I think exchanges have different tools. You could use Excel as well. But the biggest thing is you need to make sure never to risk more than kind of the allotted risk per trade. So any questions on that stuff, Billy? No? All right. So can you guys still hear me? I don't know if Billy... Cool. I think we're still good. You guys can hear me, right? Okay, Billy's muted. No worries. All right. So the last section I wanted to discuss was kind of a prop firm overview. So again, a lot of you aren't familiar with prop firms, and they can be really powerful if you understand them and if you understand it. So again, kind of apologize for the text, but essentially, what a prop firm is a company that allows you to basically purchase a challenge of some sort, and if you pass the profit targets with good risk management, then you're able to trade kind of a quote unquote funded account, and then typically keep 80 to 90% of the profits you make from that. So it's a really cool way to scale a lot of capital without having to fund it personally with yourself. And there's kind of three different ones I want to discuss. So CFDs, like I said, they are less regulated and have been kind of the prominent prop firms for the last few years. They typically have kind of a one-time payment for the various challenges, usually like an 8% profit target for the first phase, 5% profit target for the second phase, and usually like an 8 to 10% max drawdown. They've largely been unregulated the last 2 to 5 years until recently. Late 2023, early 2024, there started being additional regulations, and a lot of them have been having issues with having to change platforms, losing their licenses, things like that. So this is why I personally switched to futures, because it was kind of honestly a shit show with these CFD prop firms, with all these challenges that they're facing right now. And the scalability, like being able to mirror the trades across different accounts, was kind of was definitely damaged with all these issues, because now they're using all these different platforms and there's not the technology to kind of copy the trades across them as easily. So I'm personally trading futures prop firms now. Most of them have kind of a monthly payment during the challenge, which I actually kind of like. It's a smaller fee while you're working on the challenge, and then once you pass it, there's like a larger activation fee to get funded, but you don't pay that until you actually pass the challenge. So I kind of like that. It's typically cheaper than the CFD prop firms. The profit target and drawdowns are pretty variable. Like it's kind of all over the place, but in general, it's smaller than the CFD one. So instead of maybe 8% and 5%, maybe it's like 6% profit target, or 3 or 5% profit target, and then the drawdown can be as low as like 2%, 3%. So it's smaller profit targets, smaller drawdowns, and then a lot more regulated, like pretty consistent platforms at this point. I made the switch, and I don't expect to have to make the switch in the future, given that futures are highly regulated in the traditional finance space. And then I just briefly want to mention there are crypto prop firms. You can't get anywhere near as much capital. So with both of these traditional finance prop firms, you can get multiple seven figures pretty easily with the number of different firms and the trade copying capabilities. With crypto, you can still get like about 100 to 200K, but a lot lower than the others. And there's really only two available at this current time that I'm aware of. This Crypto Fund Trader. They have a couple kind of hidden rules. There's no hedging, so you can't be like long and short at the same time. And they have like this profit cap per day that some people don't like either. Breakout is actually a newer one that Trader Main, some of you might know him, he started with some others. It has lower leverage, but it has more pairs. Like you can actually trade some of the popular shitcoins on this platform, and they have less hidden rules, and I think they use Bybit's liquidity. So if you want to check out a crypto prop firm, I recommend Breakout. And in general, I didn't mention this in here, but I would really recommend, if you want to try these prop firms, my biggest kind of recommendation is don't go for the large accounts until you have proof of concept with passing and maybe getting a payout on a smaller account, because otherwise you're just probably wasting your money on these larger challenges. I've wasted a lot of money early on, going for these $1 million accounts and things like that, when I should have just been practicing on these 10, 20, 50K accounts to build proof of concepts before I was ready to scale up. And I have in the appendix a couple files comparing a lot of these different prop firms that you can also look at. So it sounds like Billy's mic's muted, so I'm just going to take a second to look at this chat and see if there's any. You're back.
I was struggling with the button, but there was a question from just a little back, and that's what I was talking already, but somehow I was muted.
Okay.
someone asked, do you recommend this for crypto? It was still regarding this trading strategy. And there was also a question, do you like to trade, do you also trade bigger RR than 1 to 2?
So, I think I'd mentioned that strategy you would have to backtest. Like with any strategy, you'll have to backtest if it works on one pair or not. Like, if I hadn't backtested that strategy on the Nasdaq and just started trading it, like I would have been really surprised that it was not giving me the results. But since I backtested and realized, wow, this strategy actually kind of sucks on the Nasdaq, that gave me the information I needed to not do it. So you really have to kind of, even if you have a profitable strategy on one instrument, you have to backtest it on others to see if it's consistent. And then in terms of the risk to reward, I do. So with my strategy on the US 30 and gold in particular, I was able to identify that a tighter stop loss was better on those over time. So some of the trades can get up to 5 to 10R with that tighter stop loss. I'll start at the 2R plus, and then when I tighten the stop loss, it increases that risk to reward. So for me, that's kind of what I used, but for the most part, I think it's probably better to go for a higher win rate, lower risk to reward than a 10% win rate. But when it's right, it's a 20R trade. Just because your drawdown is going to be a lot more manageable if you have a better win rate. So I would suggest, like I said, anything that's over 50% win rate and at least 2-to-1 risk to reward, like you should be in the money, pretty consistently with something like that. And then I think the second question, no, that was the second question, right, Billy?
There was a second.
Yeah.
I have one more personal question because I backtested um, my strategy, but I did it through TradingView.
Okay.
Is is there a big difference with FX?
So the biggest advantage of FX replay versus, because with TradingView you just kind of have to like manually write down the results, right?
Yeah.
Yeah. So the biggest advantage of FX replay is like while you take the trades behind the scenes, it's kind of capturing those analytics for you. So it's a lot more efficient to kind of just go through, okay, I would have taken this trade, I would have taken this trade, et cetera, et cetera. You can kind of you can like tag certain trades with, like, this was this entry, this was this entry, and you kind of drill down those analytics. So it just like, it's more efficient, I guess, than TradingView. Obviously it is $30 a month, but yeah, TradingView is an option. It's just a more manual process, I would say. And that you don't get all those analytics as easily.
Yeah, true. Yeah, Kai Sato says in TradingView you can write a strategy that calculates everything.
Yeah, if you have a programmed strategy, you can use the strategy tester. But
I did that with my own strategy, but as soon as the market is going sideways, moving averages get less reliable.
right.
So then you don't want to take a trade, but the strategy is taking trades, and that's something you don't want to.
Yeah, and that's where, like, in the automated version, it's obviously capturing everything, but you might identify, when this is present, I don't want to take these trades. So that's why, the ability to kind of eliminate those trades you don't want to take is kind of better to give you that, more accurate information.
Cool.
Cool. And I saw some information from My Room is Cold. I think he's traded some prop firms. Yeah. So looks like $250 for a 50K account. I think Breakout's probably somewhat similar. So yeah. Let me know if there's any other questions, but I think there's just a few more things that I wanted to go over in here. So I guess kind of prop firms versus live accounts. So obviously, like I mentioned, prop firms require a lot less capital. I think with my most recent, I have basically 23 $250,000 accounts funded right now, so just under 6 million, and I paid just over 10,000 US for that. So just to give you an idea of how much capital you can get for a pretty low cost up front. And then I would say the second thing is most prop firms are definitely more oriented towards like day trading, especially on the traditional finance futures side. You can't like hold trades past market close like with any of them, so you have to really focus on the day trading aspects versus swing trading. I think some of the CFD and crypto ones you might be able to hold kind of weekdays, but maybe not weekends. That's, again, you got to kind of check the details. I will kind of mention only about 5% of people that trade with prop firms ever get to a payout, but obviously the barrier to entry is super low. Some of these, anybody can, a lot of people treat them like a casino and just try to, all in their accounts, and obviously don't pass and don't get funded. So there's a lot of people that don't do it, but it is, statistically challenging to, but again, it's hard to make money as a trader in general. And then you need to be really detail oriented with the various prop firm rules. You got to read the fine print and make sure that there's no hidden rules or anything. And again, the comparison spreadsheets that I've got linked at the end of this will help with some of that. And then there's really an amazing scalability with trade copiers. So, I trade a single 250K account right now, and it copies the trades across all my other 22. So I'm able to scale that super easily, and potentially even continue scaling further. With that. So there's a really awesome capability with the traditional finance in order to do that. And then traditional finance versus crypto. I think I've mentioned some of these, but a few of the things that really drew me away from crypto to the traditional finance space is the volume tends to be more consistent during the London session, New York session, instead of random kind of spikes happening Saturday 8 p.m. or 2 a.m. on a Thursday. So I found it a lot more peaceful for me being able to say, okay, I'm going to trade the New York session. I can get up and trade that day. It won't mess with my sleep schedule, my life, my sanity. So it's easier for scheduling kind of when to trade, in my opinion. And then crypto also, I guess, is less scalable. Like I mentioned, you can get 100, 200K with the prop firms versus 7 figures with the traditional finance. And I think even if you have a funded account, probably the biggest, whale I've ever, interacted with, he had to use like 5 or 6 different exchanges to get the size he wanted with some of the bigger plays, versus traditional finance. You could have those just in a single broker with multiple accounts. Crypto is obviously 24/7 market, so that is like the biggest appeal to it. You can kind of trade it all the time if that's something you're into. But it also has a lot less predictable news events. I'm sure you guys have seen the real and fake news with the ETF stuff in crypto. So you'll more often get kind of caught, I guess, with these unpredictable news events compared to traditional finance, where outside of major war events, which really mostly affects like gold and stuff, you can pretty much know like when the major news events are happening. So there's more predictability. And then I would say there's just less available software currently for efficiently backtesting and tracking your crypto trades versus traditional finance. So I'd mentioned FX Replay has like 6 crypto pairs right now, but there's a lot they don't have, and there's probably some variability from the exchanges you're using, and then to track the trades and things like that, it's harder to get the data. You have to just kind of manually do it for the most part to get the analytics you want from your live trading. So those are kind of a bunch of different reasons that I ended up doing traditional finance versus crypto. Is there any kind of questions around that, Billy?
No, man.
Okay. So yeah, I wanted to have some time for Q&A, and then obviously I mentioned I've got some resources at the back of this that you guys can take a look at as well. But yeah, we'll go ahead and kind of open it up for Q&A. What do you guys got? And if anyone wants to come on the stage too, feel free.
Yeah, Guzel, the Dutch way, is asking to speak permission. So
Yes, hey guys, can you hear me well?
Yeah.
very, very well.
Great. So I had a question about this trade copying software to be able to like execute multiple trades from one base platform. What kind of software do you use for that, or did you build the software for doing that yourself?
So with the CFD prop firms, the number one platform that people used to use was called Social Trader Tools, but it only works with MetaTrader 4, MetaTrader 5, and that's the platform that a lot of these prop firms have lost access to with the regulation. So that's when I'd mentioned that the scalability was kind of having issues with those firms. That's what I was kind of referring to, because a lot of them have had to switch to like DX trades and these other platforms. They no longer have access to MT5. But when I was trading with them, I think I had up to 14, 18 accounts kind of linked with Social Trader tools. And then for the futures, there are more options with futures. The best one that I've come across is basically an add-on for NinjaTrader called Replicanto. And again, this is probably something that's worth either a side conversation or a separate call. Like I'm happy to go into more detail on the kind of tech behind it, but it's basically any futures prop firms that are Tradovate, or I guess most Tradovates or NinjaTrader platforms for futures, you can use Replicanto for. And crypto, I think you would have to have some kind of custom API thing, maybe 3 commas, or yeah, a custom solution that it might exist, but I'm not currently aware of one. But yeah, you'd have to have kind of a separate thing for crypto, I think.
Yeah, okay. Sounds interesting. Thanks.
Yeah.
Cool, guys. Anyone else want to jump on or type some questions?
Yeah, and Billy, I know I'd mentioned this to you before. If the group wants, like I said, I'm happy to do follow-up calls to demo FX Replay, or kind of dive into, I can share more information about futures prop firms specifically that I obviously trade. So if there's a desire for something like that, or kind of follow up, happy to do that later. But I'm mostly in the traditional finance chat, so you feel free to ask questions in there as well.
No, that sounds like a plan, and I think we can come up with with a few streams. And there is only like a couple of people in the traditional finance group. I'm like the one who started the group, so I'm happy to have you around, and hopefully more people will join in.
Yeah, and like I said, whether it's crypto or traditional finance, I do think this process is replicatable. I mean, again, you might need to get a little more creative if you're, a shitcoiner, maybe back testing, what market caps do things typically get to, stuff like that, a much more manual process. But I think, any way you can back test what you're trading, you're going to have better information. But obviously, the easiest way is just trading time and price and having that historical data to get the analytics. But yeah, I think this process can work with really whatever you trade, whether it's live accounts, funded, prop firms, crypto, or TradFi. It's just a matter of finding that edge, the variables, and then kind of committing to executing it.
100%, man. This is a very important stream, and in many ways, I've talked about this on my own stream. Like, I just have like a set of rules that I just, like you said, mechanically follow, and basically do always the same kind of stuff. And very very interesting, very nice stream, man.
For sure.
Is there anyone who wants like the last minute question or something? Should we round it up?
Yeah, that sounds good. And like I said, Billy, I've got the recording, so if we decide to share it, just let me know. It'll take some time to process, but happy to share that if you want.
There's one more question.
Okay.
Do you use indicators or just patterns?
So personally, with my strategies, I really only use, I guess I would say, kind of 2 indicators on TradingView. There's this fair value gap indicator by Spaceman BTC that I really like. That you can kind of customize what time periods it shows the fair value gaps. And then some of the charts don't show news on the chart. And I think there's this, I can't remember the name of it. I linked it in the traditional, or the community resources, I think, a while back. But I think it's there's a news indicator by 2 degrees that puts like the, what's it called? Forex Factory news events during the week on the chart, so that I make sure not to trade, when there's news. But those are really the only two that I really use for these strategies.
Cool. Well, very important stuff, man. This is like the basics around being successful for a very long time and not just only relying pure on luck. And that's where what I really loved about this stream, man.
For sure.
And yeah, let's see what we can do in the future. Sounds like a very good idea. I want to ask everyone to just remind you you can give out points, and I think Ox Fibonacci, right?
Yeah, whatever works.
Yeah, yeah. He searched that, so we can have him for a longer time in the group.
Cool. Well, yeah,
Cool,
thanks
man.
for joining, and yeah, it was good sharing with you guys, and feel free to ask questions if there's stuff that comes up later.
Definitely. Okay, guys. Thank you, everyone, and well, see you next time.
All right, see you guys.